All right, hey there everyone. This video lesson here is going to be kind of a supplemental to the volatility video I just did. That one got really long, and I just want to make sure that I kind of fully explained what I was intending to. I used one example that, I don't know, maybe kind of did or did not show pretty clearly the impact that volatility can have on different trade positions. So I want to just kind of add a second one here to it, just to maybe add a little bit more to what I was trying to show you in the last video. So what I think I want to do here is I've picked a few different areas over the last year and a half or so that I want to just spend a couple minutes and walk through a few different types of scenarios, okay? And just to show you how the market acts to different types of positions and different types of spreads, okay? So specifically, I'm going to identify three different areas. I want to look at this area right here at the end of October, when the market was coming out of some high volatility, dropping back into a range, as well as a pretty strong move up in price. I'm going to show a handful of different ways you could have played that from the long side, just to show you the different potential from both playing on volatility as well as playing on price. Okay. Second area that I want to show you is this area right in here, the middle of March, where volatility is kind of just staying in a range. It's not at the higher edge of extreme, it's not the lower edge of extreme, it's just kind of in this center point. And this just to show you how that affects similar types of positions when price is moving sideways, a little bit of down movement, a little bit of up movement, and what you can expect from that. And then last, I want to show a little bit of trading at the end right here of 2014, when same way the volatility was staying well inside a range. We had a lot of bouncing around, but also we had some sideways movement. And this area, I want to just kind of show you how you would play more of a non-directional. I'm not picking long, I'm not picking short. I'm just letting the market kind of do what it will do and see how the various different types of option positions perform. Okay, so these three different areas are all very unique and different from one another. But I think what you'll notice is these option trades, these positions perform very similarly. Okay, some are obviously way more profitable than others, and some of them, don't do well at all. But the whole point to this whole entire lesson about volatility is don't try and manipulate what you cannot control. Okay, you cannot control volatility. You absolutely can control your attention to risk and your execution of your trades. So let's just jump in here to October 21st, 2014. And you'll notice that the gigantic move up in the Russell on that day. We had about 31 days until the options expire. And right off the bat, I just want to talk about, let's just go in and let's do some long calls. Let's do 12 long calls right at 11:50 right here, okay? I think I did a pretty poor job in the last video keeping apples to apples, okay? If you're going to do some back testing, and if you're going to do some position modeling, and if you're going to do some learning, you really need to keep these very similar position size, similar amounts, and that gives you a lot more data points and a lot better information to make your decisions. And that's what I want to do here. So the position size for each one of these trades is going to be $10,000. And I'll just step through a few days at a time, and you'll notice right off the bat, that's the maximum risk is about $9,300, $9,700. We've got unlimited potential to the upside. And this Vega, while you remember October 21st is this area right here, okay? High volatility environment. We will benefit most from a drop in volatility. So we do not want to be long Vega unless we are taking a heavily directional position, which we are, okay? So I'll convert that trade. That's what it looks like. That's what you're going to see. So we'll step forward just a few days in time just to show you that, you know, you've got well over $300 each day to overcome in time decay, but you also have a very heavy delta number, which kind of is going to overcome this theta drain. So a couple days in, you know, you're up almost 1%. We'll just keep going. So a few more days, just to show you, I mean, the absolute potential. 100% right here. 6 trading days, you're up 100%, and you still have unlimited profit potential to the upside. At this point, you either close the trade, you forget about how volatility is affecting you, you've successfully picked a correct direction, forget about the theta drain, and either close your trade or step on the gas. Let it ride. If you've position sized yourself accordingly to your account, okay, well, step forward a few more days and, you know, you'll see what the potential is. You really, this is all you can control. I mean, come on, right? 25 grand, that's what you're playing with here. This is the game, all right? This is reality. If you control your risk and you position size appropriately, these kinds of win trades are all over the place, all right? So at this point now, you know, you are guaranteed a winning trade. You still have continued potential to the upside. You have just come out of a gigantic move up right here. You know, you can see it's beginning to start petering out. So if that is your position, you still have a couple weeks to expiration. Well, what do? Maybe you just sell half of them. You have locked in a guaranteed win while still preserving that advantage if it continues to rise to the upside. Again, maybe that's synonymous with trailing a stop, or, you know, protecting your capital, moving your stop to break even, however you want to imagine it. Once you successfully pick a direction, well, great. I mean, look at the potential. It is absolutely there. So that's one way you can play it, right? Here's another way. Let's just go back to the 21st. Let's say that we don't want to take that heavy of a directional bias, because if we're wrong, you know, maybe we're going to be losing a lot of money pretty rapidly. But I still believe that we've found a bottom, and you'll notice that this right here, 1150, okay, maybe in your mind that's a pivot point, a pivot zone. You know, I mean, you can see price rotating around that. So if that is your assumption, if that is your bias, and you want to target 1150 right there as your area where you want to construct a trade, well, okay, fine. Let's go to 1150. Let's go ahead and maybe do something like this. Now we have created a time spread that is still Vega positive. It's still volatility sensitive to a decrease. But if we get a nice good price movement, and actually let's keep it 10,000. All right, let's keep it same as the other one. 9,200, that's fine, that's close enough. And if we zoom up to our 1150 assumption, well, we're going to be in a very profitable trade, nowhere near as profitable as the first one. But if we're wrong and the market begins to go against us, we absolutely will not lose our full $10,000 like we did on the other trade. All right, so you trade off one for the other, and we'll just kind of do the same thing, just go for it a few days at a time, see how that performs. You know what the outcome is going to be, I think, because it obviously moves up to that area. And while it's nowhere near the profit that you made on that directional call, you can absolutely see that there are still opportunities to, okay, well, maybe I want to, let's take some of these, take some of those. And now, again, I've created almost a 100% winning trade, and I have protected my capital. Or you just close a trade and you be very happy with making 30% in 2 weeks or 12 days, whatever it is. So that is one way of utilizing a different approach, just using these options. And while, yes, volatility is very important and you need to be aware of how these actual prices are impacted, either positively or negatively, you still need to position size your trade properly to your account, respect the risk, okay, don't over leverage yourself, and take your profits when they're there. Another way of maybe setting this up is, we could do something along this setup. We could go maybe 8 here, we could go maybe 4 here, and maybe go 4 like here. So again, we're rotating around that 1150 assumption, but we're constructing it a little differently now. See, now we're going to try and take advantage of that decline in volatility while still leaning heavily bullish without taking a straight up, actually let's do 5, 10, and 5. Without taking a straight up directional long call, and this is what that looks like, all right? So we're still going to participate in upside profit. We have much more limited risk if the market drops fast. There's time to navigate out of it without absorbing a 100% loss. And again, these can be position sized to whatever account amount you have. I just picked 10,000 because that's that's an easy round number. But you have to understand there are many different ways to take an opinion, take a bias, whether that's directional or non-directional, and use options to get in on the move. And the more risk you take with a directional straight up long call or long put, obviously the more reward you may incur, but the more risk that you're going to take on to gain that. And so then this one right here, you'll see what that trade does is obviously it performs very similar to the time spread, to the calendar. But what this structure did is it guaranteed us no way of losing to the upside. You'll see right here, we could put this on and walk away from the computer for 3-4 weeks. And if the market screened up to infinity, well, we know we're going to be guaranteed to make $930 no matter where the market goes. It can go up forever. We don't care. And if it goes down, this sloping graph of this dotted line is a lot more forgiving and a lot more gentle than if we go something like this, right? Oops, no, that's a put side. Got to do the call side. Got to make it all equal. If we did something like that, I mean, look at how sharply inclined that is. We get a 20-point move down, we're going to lose a boat ton of cash quickly versus, we have this position and we get a move down. It's a lot more forgiving. It's a lot more gentle. So that's one area. That is the 21st of October. All right. Let's go to the 21st of March. And again, I want to use some very specific examples because I don't think I did a real good job in that last video. This one we're going to look at just this kind of March area where we had some sideways movement, but then it started dropping. But the difference is, look at where volatility was at. It wasn't at this crazy extreme like it was up here. It wasn't at the low like it was down here or where we're at right now. It was just kind of waffling in between this range where it had been, where it spends the majority of its time between 17 and about 23. This is volatility specifically on the Russell. Okay. So this one, let's say that we come in here and we do 10 long puts at 11.50. Again, you notice we're 28 days to expiration. We'll go 10 long puts at 11.50. We've got a $10,000 trade, and we are taking a directional opinion that the market is moving down. Why did I take that opinion? Well, let's just say we're looking at right here, price chart. Okay, this is what the market is doing. We don't know what's coming in the future. And let's say that, you know, we had some prior area of resistance that became support that broke through, but now we've got some pretty strong support underneath it, and we're targeting this 11.50 to hold. Let's say that's our opinion, that's our assumption, maybe a head and shoulders formation beginning to start, if you will. So if that's the opinion, that's my mindset going into this, I want to construct trades centered around this number right here, 11.50. And you can do that either using straight puts, a long put, which again, the Vega is this volatility representation. An increase in volatility brings $1,000 into the trade for every 1 point of increase in volatility. So if the market begins to move down in our direction like we want, and volatility increases like it does right here, you almost get that kind of double whammy benefit for the risk that you've identified up front. And so again, you know, it's kind of the same thing as before. You know, you'll see that your theta is this negative number that you're trying to overcome. You had a big move up here, so that's why we're, you know, not getting a big return yet. But you'll see that when it starts coming down and volatility comes up, well, we will end up, there we go. You'll see that we ended up started to move, and at that point, you either close it, you're happy with a 70% return on margin, or you lock in your profits, you sell half of them. It's essentially moving your stop to break even or a little bit more, while still being in a trade opportunity that will continue to benefit if the market keeps dropping. Okay, and then let's just do one more in this one, and then I'll jump to that November 14th section. Let's say that we want to look at maybe a diagonal, all right? And again, these are different types of spreads that you should and could be practicing, so that you can get just extra familiarity with you know, what kind of trades you like, what's comfortable with you, what fits your personality. We are all different. Some of us like different things, but again, let's say that we're centering around 11.50 and we want to do something like this, where we have sold 7, we've bought 7, we are volatility positive or Vega positive, we want the market to go down, and if it goes down, and if it settles in around 11.50, this is where the bulk of our profits are going to come from. If it moves against us, we will begin to incur loss, but it is a lot less rapid than if we just go in and buy a straight long put and want to get that immediate 1-to-1 risk to reward. So we do something like that, and then you know, we just move forward, you know, 3 or 4 or 5, 6 days at a time. These numbers change every single day. We could move just 1 day at a time. You could move this 30 minutes at a time. I am going to do a whole entire video lesson on trade journaling, or trade planning, journaling, and back testing, and I'll speak a lot more in depth about if back testing and trade planning how it is so often done incorrectly, to your detriment, really, where you have to back test how you trade, and you have to plan your trades and journal your trades how you trade, and very, very seldomly do people actually do that. They back test one way and then they jump in the live market and then they begin trading entirely different. Okay, can't do that. So I'll have a whole entire video lesson on that as well. But you'll see that the market moved down. We were correct on our where's price going question. And so what did? We took a $10,000 trade and we made almost 50% in about 2 weeks, 10 days or something. So that's, the potential is absolutely there, and the power to completely respect your risk and take advantage of some of these directional movements without bringing in a one-to-one kind of variable, I think is what makes, in my opinion, options the best thing ever. And I know everybody's not going to share that same sentiment, but I certainly hope that there are some of you that really see the potential that this offers. And then last, let's look at this little area here of the chart. Let's look at 1114 in this area. We had just sideways movement, just, you can see it's, kind of some just range-bound trading. And as well, you've got just kind of this range-bound volatility. It's maybe more on the lower edge of this center range, but we certainly are not at one extreme or the other. And that is 2014. And what I want to show here is, again, I want to show more of like if you go into the market and you don't have an opinion, you don't really have a thought, you don't know, you don't care, you're not taking that hard directional stance to where, okay, you come and you look at this, well, is it going up or is it going down? Who the heck knows? I don't know. Where, prior examples, you can see some good support. You can see maybe head and shoulders forming. You can identify maybe this area here. You can maybe identify this area here, and you can say, well, it might go up to 1200 before it comes back down to 1100, or it might just rotate around in this area. Either way, I don't know where it's going, so I'm going to create an option trade based upon volatility being in this center range, based upon price being in a kind of a range-bound environment, and let's just watch what happens. So same kind of thing. I talked about trading straddles when you don't have an opinion, and that gives you that profile. It benefits if it moves up or if it moves down, but if it sits right here in the middle, you are going to bleed $138 every single day as it sits right here. This is not optimal for a range-bound market. But how do we know if this is going to be a range-bound market when we're looking at this on a chart? We don't know. We're saying it might go up, it might go down. I don't have an opinion, so this is one way you can take advantage of that because, we don't know what's coming next at this point right here, or this point when we actually started the trade. We don't know what's coming next. So when you do something like this, again, you get an increase in volatility, you will benefit, but it has to be enough to overcome this daily drain that you are going to incur on theta. And you'll see, yep, we're losing. It's kind of just sitting here. We know it's going range bound, so, it's not a surprise. And, this becomes a losing trade. But if you have your parameters set at the beginning, I don't want to lose the full 10,000 maybe, or maybe you'll say that's fine. My account can handle that. I'm willing to risk 10,000 because I see what the potential is. So I'll let it go all the way to the end and see what happens. Or you can wait until you're down 10 or 20, 30%, close it, adjust it, reposition it. I mean, you have these choices, you have these options that you can do. It's no more of the factor of just, it's either going to hit my target or it's going to hit my stop and that's it. you definitely have choices of things you can do. Another possibility is you come in here on a directional or a non-directional opinion, and let's say we want to just do something like this. Say that we want to go 1140, 1120. Let's just say we want to do that. Let's say we want to do minus 10, plus 10. Actually, no, we'll do minus 5, plus 5. No, you know, that's too close. Let's do this. Let's go 1100, all right? Minus 5, plus 5. And we'll come up here to, let's say 1230, minus 5, plus 5. So again, it's a call credit spread. It's a put credit spread. This is what it gives us. This is the profile. We have defined risk. We have defined profit potential. It's not unlimited, okay? It's defined, and we know where we can make adjustments. Again, this is on a non-opinionated viewpoint, and if the volatility decreases or stays range bound, this is what we make or lose every single day. So we convert that, move forward a few days in time, and we'll just kind of see what the theoretical profit and loss numbers are. Again, you see that each day that passes in time, you bring in this much money into your account because these options you have sold are decaying faster than these are accelerating. They're all decaying, but what you've sold is decaying faster than what you bought. Okay, and then you'll see, you know, you're up $1,100 on 8,000 of margin, which actually we should probably make that we'll make that 6 just to keep all things same. Yeah, 9,600. So, you know, we're say we're up 1,300 on 9,600 of margin, and there's still, you know, 2,300 that's left in here at expiration. So you can take that non-directional bias or that, you know, I don't care where the market is going viewpoint and create same kinds of trades, independent and irrespective of what volatility is doing. But if you do stuff like this and you don't understand how volatility can impact that position, well, you're really setting yourself up for losing a lot of money and not knowing why. And I think the only thing worse than losing money and not knowing why is making money and not knowing why. Because here's my philosophy, all right? And then I'll wrap this up again. I only wanted to put together another 5 or 10 minute addition to the last video, but it's again turned into 30 minutes. I'm sorry, but here's my philosophy, right? The most dangerous thing in the world is to make make money on a trade and not know why, especially when we're talking about options trading. If you make money on a directional currency or a futures trade or a stock trade, or if you trade bonds or whatever, and you make money, you know, because I picked direction correctly, I read the market right, I either used my technical analysis skills, I used my fundamental analysis skills, I was successful in reading the tape, and that's why I made money. Or I was unsuccessful and I picked wrong and I lost money. And then you manage your risk, you position size accordingly, and you live to trade another day. With options trading, there's a lot more that there are many more elements and factors to it with the time decay, with volatility, with price. You have a lot more that's working for or against you. And if you make money because you picked direction and price did not move in your direction, but you made a ridiculous return because of volatility deflating or inflating, guess what? You have just added confirmation to your psyche that, I got this figured out. I know what I'm doing, and I'm going to lever it up the next trade because I'm good. And it's just, it's a dangerous, dangerous game, because when that happens, inevitably, you're going to lose and you're not going to know why, okay? I would rather follow my trade plan and lose money 10 times in a row than to make money and not know why. I guarantee you, when I make money, I know why. And when I lose money, I know why. And so volatility, while some people will say that it is the most important thing to understand, I maybe disagree with that. I think it's very, very important to respect it and be aware of it and have knowledge of it. But I think the most important thing is your risk management and respecting your trade discipline. If it's time to close it up and take your loss, close it up. If it's time to take your profits, take your profits. If it's time to adjust and add or take capital out of the trade, do that. And so that's all you can control. And you can't control volatility, you can't control price, you can control you. So anyway, that's it. Will stop rambling, I promise. Volatility, it is important. It's the silent killer. It is, it's dangerous, and it lurks there in the shadows. So you just please be aware of it and try and learn more about it. And as always, send me any questions, and we will be talking more and more about this as the weekly webinars and lessons get underway. All right, so thank you again so much, and have a great afternoon. Bye-bye.